Analysis: investors gauge U.S. shares rebound, suckers, rally, or market bottom. New York: as traders watch for any other jumbo-sized fee increase from the Federal Reserve, they are taking the temperature of a weeks-long U.S. inventory marketplace rally that accompanied a vicious first-half sell-off. Even after Tuesday's sharp fall, the S&P 500 remained up 7% from its June 16 low, buoyed in part by expectancies that the Fed will pause its aggressive rate hikes early subsequent year and a recent decline in commodity fees that buyers hope will assist ease inflation. So some distance, the bounce has its percentage of doubters. 3 rallies of comparable importance have already wilted this year, with shares sliding to new lows whenever. BlackRock NYSE, Block, the arena's biggest asset supervisor, on Monday warned investors that more volatility lay ahead and mentioned it turned into underweight developed marketplace equities on expectancies that inflation will stay tenacious. "We think that is a undergo marketplace suckers rally," mentioned Steve Chavarone, senior portfolio manager at Federated Hermes NYSE, FHI, who believes the Fed will stay hawkish longer than predicted and has decreased his fairness publicity as the S&P pushed higher over the previous couple of weeks. Expectations that the Fed will stop its market-bruising price hikes earlier than forecast have helped electricity stocks better. Nearly 2/3 of traders now agree with the Fed price range rate will stand at 3.5% or lower through March 2023, up from just a third a month in the past with that view, in keeping with CME. Investors assume the Fed to deliver another 75 basis points of tightening Wednesday, after already raising prices via 150 foundation factors to date this year. FEDWATCH hopes for moderation after that might be dashed if client expenses continue to be stubbornly excessive in coming weeks, repeating a scenario that dragged stocks decrease this 12 months, BlackRock strategists wrote. Inflation information could marvel to the upside and cause markets to unexpectedly fee a better rate course another time. Result: any other equities sell-off, BlackRock strategists wrote. Data from the Wells Fargo NYSE, WFC Investment Institute confirmed the severity of the cutting-edge bear market, which noticed the S&P 500 fall as a lot as 23.6% underneath its January excessive may additionally rely upon whether or not the economic system is in a recession. Bear markets accompanied via a recession have lasted an average of 18 months, at some point of which stocks fell an average of 35.8%. Without a recession, indoor markets lasted a median of 5.9 months with a median decline of 27.9%, the financial institution's information showed. On Sunday, U.S. Treasury Secretary Janet Yellen stated the threat of a recession, however stated it changed into no longer inevitable. Still, parts of the marketplace have endured to mirror investor unease, even as broader averages have bounced. More shares have published new lows than new highs at the Nasdaq Composite Index for 76 immediately days, the longest such stretch in 20 years, mentioned Willie Delwich, funding strategist at All Star Charts. The index is up nearly 9% from its June low. Until that dating changes, it is premature to mention that a backside is in vicinity, Delwich said. More optimistic investors factor to an array of alerts indicating bearish sentiment might also have reached a crescendo in latest weeks, doubtlessly hard dealers and making it less complicated for shares to rebound. A fund manager survey from BofA Global Research last week showed expectancies for worldwide growth and earnings at all-time lows and coins degrees at their maximum in 2 decades, 2 contrarian indicators the bank's strategists mentioned ought to indicate extra inventory gains beforehand. Short hobby within the S&P 500, meanwhile, currently stood at its highest degree for the reason that depths of the coronavirus sell-off in 2020, a signal that has took place for the duration of beyond marketplace bottoms, the bank's strategists wrote. We assume it's possible that the S&P 500 has already bottomed, and if it hasn't, we'll find a backside for the duration of the one-third zone, stated Lori Calvasina, head of U.S. equity approach at RBC Capital Markets, in a notice to traders. Calvasina lately added inventory publicity, betting that a probable recession has already been baked into costs. Christopher Murphy, co-head of derivatives approach at Susquehanna International Group, believes this week's profits reports, which include outcomes from heavyweights such as Apple Inc., Nasdaq, AAPL, and Meta platforms, should play a key element in figuring out whether or not shares can hold rallying. For the time being, the dangers to the marketplace are very well known proper now, and already meditated in costs, he said.